questions, let me know that you have. Okay, so we've got a bunch. Good. Okay. Tonight I am going to introduce Richard Brooks. Richard is one of our SCORE mentors, and we're going to be talking about financials, putting together financials, and some of the things that are important about that. And we'll start that in just a minute. Just to let you know, we will give everybody, I'm going to put a sign-up sheet together and send it around. Everybody that signs up, give me your email address, and I will make sure that you get copies of the slides that Richard's going through today. And for what it's worth, if you want, right now this is being live streamed on YouTube. We're the only ones live streaming it unless somebody accidentally happens to go on YouTube and look at it, which I don't think so. But I'm doing it so that we can record it. So if I remember, I'll send a recording out to everybody of what Richard presents tonight. So, and that way, you know, it'll be great. You'll be able to take a look. So just quickly, I know that there are a lot of people that have heard the pitch about SCORE, but, you know, bottom line is that we're here to help small businesses grow and thrive. And if you're in the process of starting a business, or you've got most
That's just an example of the importance of it. I will use examples during our presentation today, and by all means, feel free to ask questions. So let's talk about this workshop. It's going to help you develop a financial forecast. One of the most important things that you can do for your business is looking at the future and determining your future business. Now, that could be business you may have on the books. It could be based on your history. Okay, or it could be, this is what I have to achieve in order to make my financial, and therefore I have to have a plan to get there, right? More than a financial plan, an actual business plan, because we really tie the two together. Okay, it takes you through a decision-making process. We're going to talk about how it provides you with information to help you make a go or a no-go decision if you're considering developing a business versus you having a business. We have a core of information to create a complete business plan for your bankers and potential investors. And there are really two pieces to a business plan, right? One is the text, you know, the description of your business, what it's all about, how you plan on running it. But the second piece is the numbers, because I'm going to be honest with you, bankers don't look at a full business plan, okay? I always tell my clients, whatever you do, business plan should never be more than 15, 16 pages. I had one client that actually did a 110-page business plan, okay? And my first question to him was, have you seen a psychiatrist lately, okay? Bankers aren't going to look at that, okay? They're going to look at your executive summary, They're going to look at your background, your experience, all that kind of thing. Okay. They're going to look at your marketing plan. And they're going to look at the numbers, the financial plan. Okay. And that's what they're going to look at. The rest of it is for you. It's not for investors or lenders. And finally, it gives you the key directions you need to get started. In other words, how do I actually move this along financially and make it work? Okay, so what we're going to talk about today is these 7 items. What's the difference between financial accounting and managerial accounting? You need to understand that, okay? Because they're really 2 different forms of accounting. What is financial planning? How to create financial projections. Forecasting sales. We're only going to spend just a little bit of time on that because we really covered that in previous sessions. Pricing fundamentals. Again, we talked about that previously. We're only going to spend a couple of minutes on that. Understanding financial statements. We're going to talk about 3 primary financial statements that every business needs to have. And if you're not getting these from your accountant, or not getting these out of your QuickBooks or your Xero or your FreshBooks or whatever you're using for your accounting, you need to go back and think about that, because these are really your key tools. And then finally, how to deal with record keeping. So that's what we're going to talk about in our session today. Okay, financial versus managerial accounting. Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. It's looking backwards. What did I do this month? What did I do this quarter? What did I do the year to date? It's looking backwards, okay? It creates a historical record. And one of the reasons why we want to do that is, has anybody here ever heard the term, the past is prologue? Okay, no, okay. Well, what that means is your history will often determine your future, okay? An example I like to use is airlines. Most of us here have probably traveled on airlines. You go to the airline system online, or you use the OTA that she's creating, and you want to go from Cleveland to Chicago. So you go to the airline, and the airline says, what day do you want to leave and what day do you want to come back? And based on that information, they have a whole series of history of business traffic from Cleveland to Chicago and back. And they know if it's going to be busy or if it's going to be slow, and they determine their pricing on that. If it's going to be a busy time, like the coming weekend, the holiday weekend, the prices are here. Okay. If it's the middle of the week and you're only going for a day, the price might be down here. Okay. It's less busy of a time. So that's all based on their history of what they have done in the past and the demand that they have seen. So that's financial accounting. Managerial accounting takes that information, and it's the process of using accounting information, your history, from revenues to production inputs and outputs, so forth and so on, to track the organization's progress toward attaining its stated goals. In other words, it is a forecasting tool. It looks forward, not backwards. When you go to your a lender and you're just starting out, okay, you are going to have to give them a 3-year forecast of your business. If you have business experience in the business that you want to start, maybe you work for another company, now you want to go out on your own, your experience will tell you whether the business is seasonal and the pricing of your products and all that kind of information. Okay, so managerial accounting is forward because it's going to help you forecast for your lenders and your investors. Financial accounting looks backwards. Okay, when I was running hotels and restaurants, every month I would get a financial statement, and I would look at those numbers, compare it to my plan, my forecast, and say what went right and what went wrong. And then say, how do I take advantage of the things that went right? And how do I avoid or minimize the things that went wrong? Right? Was my forecasting that far off, or either up or down? Were my costs in line? All those kinds of questions I needed to ask. Okay, so let's talk about the importance of financial planning. It matches your business concept with your personal income goals. When I have a new client, one of the first things I ask them is, what are your personal goals? Financial goals and personal reward goals, okay? One of the reasons why I chose working in the hospitality industry, because my parents owned a building supply store, okay? I grew up with, toilet seats and kitchen cabinets and 10-foot lengths of copper pipe. I chose something different. And the reason why is one of my goals was to create a business on my own, okay? And I eventually, over time, I was able to achieve that. But I also wanted the financial rewards out of that. So I asked my clients, what are your goals financially and personally? Because you got to make sure that those goals align well with what the business can actually do. So, for example, you want to open a restaurant, okay? And one of the questions that I would ask you is, are you willing to put in the time? Because restaurants are, even though you may be open for breakfast and lunch, that means that you got to be there at 5 o'clock in the morning, and you're not closing until 5 o'clock in the afternoon, and the place is closed up. Are you willing to do that? Those kinds of questions. So that's an important question to ask yourself. Gain a better understanding of financial risks and rewards of entrepreneurship, okay? Because there are risks and there are rewards. This is high risk, high reward, especially in starting up. Figure out how much money you need to start and run your business. One of the major reasons for businesses failing is they're undercapitalized. They don't have enough money to get going. One of the things that I tell my clients is, when you're figuring out the amount of money you need to really start your business, make sure that you've got at least 3 months and possibly 6 months or more of working capital in your business plan, okay? So that if nobody walks in the door, you can still sustain the business for 6 months. That's really important. And one of the reasons why businesses fail is because they don't do that. They don't put the working capital into their budget. The business does not take off as they planned it would, okay? Because it takes time so that your clients know, your customers know that you exist. And by the time they start to really get going, they're out of money. So then they go back to their lender and they say, we're out of money. And one of two things happen. The lender says, sorry about that. Not my problem. Or, that's fine, but now I'll give you an additional loan, but at a higher interest rate. Okay. The old expression, when you know you're in a hole, stop digging. Okay. So plan ahead and have the money to sustain the business. Identify development and startup costs, ongoing operation expenses, and funds needed to finance the business. Create a plan to help guide future business decisions and monitor results. Every year, I would create a budget for the coming year for each department that I was responsible for. And then every month, I would compare that budget to the actual results and ask the question, what went right and what went wrong? Bob?
So explore the nonprofit.
Right. Right. What's really important to understand on nonprofit is nonprofit is a misnomer, not for profit is the right term. Okay, you've got to make money even as a nonprofit. Otherwise, you have the exact same issues. And in most cases, most nonprofits can't borrow. SCORE can't borrow. We're not allowed to borrow money. Okay, some can. It has to be in your charter, but there are risks with that as well. Okay. Finally, enables you to communicate with stakeholders. Who are your stakeholders? Your investors, your lenders, your employees are stakeholders, right? About the business finances. Okay. Any questions on that? Good. Okay. Let's talk about the importance of financial planning a little bit more on this. A financial plan is your forecast of sales, costs, profits, and assets for the first year or more after startup. Banks, typical lenders, whether they're a bank or other kinds of lenders, look for a 3-year forecast. Okay. I recently worked with a client who opened a restaurant or is actually about to start to open a restaurant. And we did a 3-year forecast, and the lender went through it literally with a fine-tooth comb. They weren't worried about, how much the steak was going to cost and how much the veal chop was going to cost, that kind of stuff. That's not what they're worried about. What they wanted to do was see how you got to profitability. Okay. And by the way, that business did not show a profit for the first 6 months. Okay. Because we built up the business plan to the point where it was realistic. You can use it to predict how successful your new business might be and understand where the money will be allocated and where it's going to come from. Okay. One of the things that I ask my clients to do is create 3 financial plans. Best case situation, worst case situation, and something in between that is a lot more realistic that they can defend to the lender if they're looking for money. Okay. Now, they only show that realistic situation to the bank. That's what they submit with their financial plan. But in their back pocket, they have the best case and the worst case situation. Okay. And the reason for that is if the bank comes back and doubts anything and there are issues in defending it, they can always go back and say, well, I understand what you're talking about, and I actually have a contingency just in case. Okay. I know what I'm going to do to cut costs and at least break even. Okay. It helps you examine the feasibility of your numbers and organize your business finances. And it's a modeling tool. And what you're going to see here is an Excel workbook later on. Okay. That will help you evaluate your variable factors, benchmark for tracking progress. Again, here's my plan. Here's my actual results. How did that work out? And finally, create a blueprint that you can adjust to achieve your financial goals. Okay, so there's a lot to this, and we're going to get into this in a little bit more detail there. Okay, financial projection templates. Well, a lot of you are going to have concerns. You're going to look at this and you're going to say, geez, I'm already over my head, and I just got here. Number one, you're all going to get a copy of a financial workbook, okay, that you can use for financial planning, okay? It has all the formulas in it already. You don't have to do any formulas. Everything is already built in. All you have to do is just plug in some raw numbers, okay? But you're going to look at this thing because it has 17 tabs, okay? And you're going to say, what did I get myself into, okay? It looks very complex. I don't think I can do this on my own. If you have any kind of background in financial management, in fact, you'll understand it. If you don't, the biggest mistake you can make is not asking for help. And the best help you can get is SCORE, okay? I was testing him just to make sure. Yes. Okay, very good. You're going to look at this, and after you start plugging in some of the numbers, you're going to say, I don't understand all the figures and the math. You don't have to understand the math. Okay. Your accountant has to understand the math, and the worksheet has the math already in there. All you have to do is understand the raw data and the results. And a score mentor can help you understand the results. I had a client who wants to open a bakery. She's been working on it for about a year, and she projected in December that she was going to sell 225,000 cupcakes, okay, at Christmas time. And I said, how are you going to do that? And she said, what do you mean? And I said, you have one other person on your payroll besides yourself. Are you planning on working 40 hours a day? I mean, it just didn't make sense, okay? But in order to make the numbers work for the year, she showed this huge number at Thanksgiving and this huge number at Christmas. When you sat down and looked at it, it didn't make any sense, right? So I had to get her to understand what the ramifications of that were. They were right in front of her, but she hadn't thought it through operationally. This is overwhelming. Yeah, if you take it a tab by tab, just break it down into small pieces, you'll see over time, this becomes very easy to understand. And I can start my business without can I start my business without doing a financial model? Yes, you can. Okay. But if you do that, what that means is you're going into the business without a plan to succeed in the business. Okay. And the number one reason that businesses fail, as you can see at the bottom, is businesses don't plan to fail. They fail to plan. They don't have a plan for how do I get to my goal, and they don't understand what happens if they don't get to their goal. Okay, so that's all part of it. Let's talk about the 5 elements that comprise a financial plan. Number one, what are your startup costs? Okay, startup costs are your fixed assets. Okay, are you buying a truck? Are you buying a building? Are you going to need computer equipment? Do you need desks and chairs and whatever else? Right? So those are fixed assets. They're long-term things that you would buy, lasting a year or longer. Okay. What are your operating requirements? Operating funds. Now, what would operating funds be? Well, they would go toward advertising. And if you're selling a product, your inventory for the product, cleaning supplies for your business, your telephone costs, your utility costs. We can go on and on and on about things. And the big difference between fixed assets and operating capital is you consume the operating capital right away. The fixed assets, these tables, sit there for a long time. Okay, so that's the big difference. It's really pretty simple. Excuse me, you total that up, and then that will tell you how much money you need, right? So required startup funds, just that simple, okay? Salaries and wages. What are you going to pay yourself? What are you going to pay any full and part-time or contracting employees that help you in your business? Okay, so you need to determine what your salaries and wages are. I have one client, when we were working through their financial plan, they were going to pay somebody about $40 an hour. And I said, if you're paying them $40 an hour in this position, I want to work for you. Okay, because I've never been paid $40. Okay. Plumbers can get that, electricians can get that, bricklayers can get that. But most of us aren't dealing in that kind of business. So you need to have a realistic view on that. Okay. Projected sales forecast. This is the hardest part of it. Okay. Is projecting your sales. But if you've got some experience in the business, or you can talk to people who have experience in the business. They can help you identify, is this a seasonal business? Are you going to be busy during the summer and not that busy during the winter? One of the things that we're working on right now, I'm on a national committee for SCORE that is developing a food truck national workshop. Okay. And it's really interesting because we have people from all over the country, and the people from Cleveland and the people from Chicago and the people from Vermont. In the wintertime, food truck business is really, really slow. We have people from Las Vegas and Southern California and Tucson that are saying, our summers are not good, especially Las Vegas and Tucson, because it's too doggone hot. People don't go outside, and so we're having an interesting discussion right now on seasonality and how we present that. Most businesses are seasonal. Some aren't. Most businesses are seasonal. Healthcare, for example, is probably not a seasonal business. Okay. But projecting sales forecast is critical. Cash receipts and disbursements. And what that really means is, are you extending credit to anybody, or is somebody extending credit to you? Okay. So one thing I will tell you right now is, do not be somebody else's credit card. Run your business on a cash basis. Okay. The old expression, in God we trust, everybody else pays cash. Okay. Very important. Don't be somebody else's credit card. I was talking with somebody recently, and I said, when you go to a lender and you show that you're going to allow some people to pay in 60 days and 90 days, once a payment gets over 60 days, banks start discounting that. So if somebody owes you $1,000 at 30 days, at 60 days, they may say that's really $750. And at 90 days, they may say that's really $500, because there's a greater and greater risk of that not being paid off. Okay. So whatever you do, don't be somebody else's credit card, and you should not request, at least initially, credit from other people. Pay your bills on time. Very important. And then finally, fixed operating expenses. What are fixed operating expenses? Your utilities, gas, electric, telephone. Okay. Rent on your space if you're renting space. Lease payments if you're leasing a vehicle. All those kinds of things are fixed operating expenses. We're going to get into this in a little bit more. I'm going to show you in a few minutes the financial template, and you'll see all that in there as a good example. Okay, required startup funds. Let's talk about the startup funds. How much money do you need to get your business up and running? Again, most people underestimate that. Okay, what will it be used for? One of the things that the banks want to know is, what will the funds that you're requesting be used for? And so one of the things that you'll end up, if you're going to apply for a loan, one of the things that you're going to put together is a worksheet that's called the Sources and Uses of Capital worksheet. Okay. And you're going to list all the money that you need, and then you're going to talk about, this is how I'm going to spend it. Okay. I need it to rent a building. I need it to build a website. Okay. And all that's going to go in detail. And you may have to show, depending on how much money you're requesting and what the lender requirements are, you may very well have to show bids on that. Okay. So, or invoices on it. So just something that you need to be aware of. Okay. What are your expected sources of capital? Really what it's saying is, where are you going to get that money from? I can tell you right now that it used to be that lenders wanted you to put in 10% of the total amount of money that you needed to start your business. So if you needed, let's say $50,000 to start your business, you had to put in at least $5,000. Today, they're asking for 20%. Okay. And if Congress doesn't pass the budget or pass the debt ceiling issue, it's going to go up to 25 or 30%, and the interest rate is still going to be higher. So you need to be aware of that. Okay, because of the Federal Reserve raising their interest rate, all the other interest rates have gone up, and that also means that the amount of equity, that's the term that they use, owner's equity, that you have to put into the business is also going to be higher. Okay, so be aware of that. Then, you know, how are you going to do this? Where's the rest of the money coming from? I have a client that has 3 loans and 1 grant. And they were able to put together this package of 3 loans and 1 grant. It was a $5,000 grant to get their business off the ground. But they had to find each one of these organizations that was willing to contribute as part of it. Okay. And then finally, how much will be financed by you and your partners and how much by other sources? Again, that's the owner's equity versus the lending, okay, or the grants, depending on how you're going to do this. Just to let you know, most for-profit businesses are not eligible for grants. There are some grants out there, okay? They're very qualified grants. They can only be used for certain purposes in for-profit businesses. But for example, Federal Express has a business entrepreneur grant program where I think they go up to like $5,000 or maybe a few bucks more than that. But there are a lot more lenders out there than there are granting institutions for for-profit businesses. Okay, so what I want to do now is I want to look at, remember we talked about startup costs? Well, the workbook that we're going to send you, the very first tab, looks like this. Okay, and for those of you at the back of the room, if this is an eye chart, I apologize. But you'll be able to see it up close, I promise you, when we send it to you. But here, real estate. The reason why they're broken out is land is forever, buildings are not. Okay, so you know, and any leasehold improvements. If you're leasing a building, then you don't worry about it. But you put in the money that you need to improve restaurant. You may be leasing the space, but you have to build out the kitchen. That would be considered a leasehold improvement. Okay. The equipment that you're going to need. Okay. One way or another, without a computer. Yeah. Email, regular basis, QuickBooks or whatever. But you might need tables, chairs, desks, you know, a point of sale system, whatever it is. Some of your businesses require you're going to need a vehicle, and so if you're going to buy it here, you're going to lease it. You don't put it there because you don't own it. Somebody else owns it. Leasing. Okay, and then other fixed assets. And these are assets last more than a year. Okay. One of the really important things that you need to do is everything that you spend on the business to get the door open. Know that, yes, I'm available or my business is now available to work with. Pre-opening. So all the pre-opening keep all the invoices. And there is a reason for that. I'll get into that. But and there's a financial benefit to that. You're going to need business insurance for your, for your business. And a portion of that. They may ask for 1 year in advance. They may ask for 3 months in advance, whatever it happens to be. So that's actually an asset of yours. Okay. Now, if you prepay in advance, they actually owe you the service, don't they? Okay. Inventory. If you're selling a product, you have to buy the product in advance so that you can have it ready. Legal and accounting fees, very important. We recommend that every business have a lawyer. You don't have to be paying them if they're not working, but have a lawyer, because most businesses involve contracts in one form and accounting fees. You need an accountant. Recommendation. Okay. American Institute of CPAs. There's an Ohio chapter. There's an actual Cleveland chapter. You can go to them. You can find an accountant. If the accountant has more than 2 names in the business name, they're the wrong accountant for you. Okay, because they're going to charge you double what the independent operator, LLP. Is look for an account, do a Google search where your business is going to be. So, for example, if you're here in Independence, I would say accountants in Independence, and you find out all kinds of all kinds of local people that can help you. And small business accountants are utility deposits. Supplies are miscellaneous. For example, paper products for your printer. Okay, cleaning supplies, for the office space, whatever. Advertising and promotion. Website comes under this. Okay. Everybody has to have a business license in one way or another. Okay, whether it be sales tax or a local operating permit or whatever it happens to be. Certainly, if you have a vehicle, you need operating permits for the vehicle. Whatever it happens. That's just miscellaneous. Remember, the money you need to keep the business going once the door is open. Okay, and that's working capital. Okay, the workbook that you're going to get. Now, these numbers come about that business piece, that business plan that we talked about in Simple Steps 1. Okay, so these are numbers that we have. $1,000 to start her business. How is she going to do that? Well, this is $115,000. And that $115,000 is 53.79% of the total amount of money that they need. The worksheet actually calculates that for you automatically. And then, where's she getting the rest of her money? Well, she's got a commercial loan of $33,800, and she's got a mortgage on the property, the land and the buildings, of $50,000. And then she's got a loan of $15,000 for her delivery vehicle. So you see how that all comes together? Quite often you will need multiple sources financing. Okay, so when you add up the 115 and the 33,000 and the 50,000, 15,000, you come up with 213,800. Okay, the worksheet will tell you if you don't have enough money, it actually flashes it in red, or if you have too much money, it flashes it in green. Okay, go ahead, ask the question.
All of the, we handle all of the making miles, all of that. It's a total of $25,000.
Okay,
How do I list?
okay. Is your business currently in operation? Or, okay, so that's an operating cost. That is an ongoing operating cost that I would put in. It doesn't really work here because these are startup costs. Okay, you'll see in the operating statement that you can insert a line in there for consultants, and it would be an operating cost for consultants. So it would actually work in this kind of area right here, but you'll have revenue. Right now, this is the startup. There's no revenue yet.
No, that's what it's like.
Okay, so that's a pre-opening cost. So if you were paying them $25,000 a month, okay, if you paid them $25,000 up front, and you paid them that $25,000 just to get the opening expense, because you paid it actually before the business really started, because you couldn't start the business without the permits. And so as long as you have an invoice from them for that $25,000, then that's fine. You can track that as part of your business operating capital, and there is a financial benefit to that I will talk to you about in a couple of minutes. Okay. Good question. Good question. Please. It depends. Okay. A lot of people just have their taxes done, their company taxes done, but they don't have an accountant to really explain what's going on. Okay. I think that's a mistake. Normally, your accountant will do taxes. The only reason why you would have two is because the accountant says they're too busy, and they're too busy. The wrong account. Okay, it should be one resource, because you want that one resource to really be a business advisor. And if it's done properly, I can tell you if this is done properly and you're using QuickBooks or FreshBooks or Xero or any one of the other accounting systems that you can put on your computer, it feeds right into there, and they help you set up. Taxes, depending on whether you're selling retail or whether you have sales tax and payroll tax, that's done quarterly. Okay. My recommendation is don't do it. Just get an accountant who does it. Yeah. So it looks like you had a question. Okay. Okay, very good. Okay, so we're going to move ahead. Okay, salaries and wages. This includes the wages for employees and the business owners. Remember to include taxes on wages. Very important. I was talking with somebody recently, and we were talking about workman's comp. Workman's comp, very important. You must pay Ohio workman's comp. And I'll tell you why. If you have an LLC, and most of you either have LLCs or are going to form your business with an LLC, because it's the easiest thing to do. You can do it yourself. You really don't need a lawyer for it. The Ohio Workman's Comp Commission can pierce your LLC and attach your personal assets if you don't pay workman's comp. Now, you don't have to pay workman's comp to contractors, but you do have to pay workman's comp to anybody that you issue a W-2 for. Somebody gets hurt on the job and they go to the Ohio Workman's Comp to pay for the medical bills. And Ohio Workman's Comp says, we've never heard of this company. You have a problem. Okay, whatever you do, pay workman's comp if they're W-2 employees. If they actually work for you. If they work for a third party or they're themselves, they're responsible for it. Okay. Typically, but make sure that you put taxes and benefits into your financial plan. And generally, taxes and benefits go anywhere between 15 and 20%, depending on what you're doing, the nature of your business and so forth. Mandatory and fringe benefits. This says about 30% of wages. That's really kind of high. Again, I tend to look at somewhere in the area of about 20% altogether. Don't forget to verify workman's comp. We talked about that. Contractors are third-party workers you do not employ directly. Okay, so let me give you an example. We have an administrative assistant at 4. Okay, we do not pay her directly. We pay her through a third party, a contractor that places people into positions like our administrative assistant. Okay, we pay them, and they're responsible for paying the taxes. Okay. Well, yeah, that makes our administrative assistant a contractor working for a third party. Okay. The third party pays the taxes, right? Right. 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 Be careful on this. Be sure that either your accountant or your lawyer verifies that people that you pay either directly or indirectly through a third party are really contractors. Okay. Ohio has very, very specific definition of what is an employee and what is a contractor. Don't think that you can get around something by saying, "Oh, they're a contractor. They're, I just pay them and it's their problem," because a couple of very famous cases out there, for example, Uber, where they said everybody's a third party contractor. Well, they had a real difficult time in court on that one, because they were taken to court to prove that their drivers were not employees. Okay, you don't want to get into that mess. Okay, and there are a lot of other examples of that as well. So make sure, and your accountant can tell you this, folks, make sure that you think that you're paying somebody as a third party, but the state says, no, they're working for you, and therefore you owe us the taxes. Okay, so be careful of that. Okay, so salaries and wages. Right out of Look at that.
Payroll. Extra crap. X.
Right. Well, you're right. But normally the reason why I'm such a standard. Different jobs at different rates in the same line. Okay? It's also dependent with the same line on your business. So, restaurant, and I'm not picking. It's just happened to be the business that I'm most familiar with, right? Um, you're likely to have a 6% workman's comp rate your first year. And if there aren't any claims against workman's comp, the second year it could go down to 5.5, and then third year it could go down to 5. I think the lowest it will go is like 4.5 or 4.75, something like that. It's all based on the history of your business, and newer businesses always have a higher rate. The reason why restaurants are so is knives in the kitchen. So please.
For someone who's in that. Other.
Well,
Right. Right. Right, right. Okay. Okay.
right, right. Yeah.
And, there was, well, you'll notice on the spreadsheet.
Yeah. Yeah. Yeah.
But she gotta be careful. On business. Like. Oh, yeah, yeah. Those taxes for yourself.
Right.
And not only that, if you wanna borrow some money, they don't like lending it to you when you're a business owner. So, two employees. You know, you paying yourself. Cause, you're an employee of your own company. Yeah, this one.
Not necessarily, because depending on how it's structured, with an LLC, you can just file the LLC with a Schedule C on your personal income taxes and your only taxed ones. But there are some structural issues with it.
So, and that is me. The workers. You want me?
Yeah, that's what you need an accountant for. Okay, and I don't want to give you a direct answer because it also depends on the business. Okay, what the risks are. You're going to be working with heavy equipment. So, what that also is, if you cannot go back. You have to use your personal medical insurance. Okay, please.
With me, the cost, about, as you know, they reckon. They work for you.
That's right, and that could be more expensive than Ohio Workman's Comp.
Right, so what I had to do in order to make all my fibers, one. You
That's right.
cannot put on their.
That's right.
Right.
That's one of the criteria that they look for.
Yeah.
In determining whether they're your employees or independent contractors.
Right.
That's a good example. That's right.
Because you
Yeah.
kind of doing numbers, and it really breaks it down.
That's right.
When I'm from, yeah, it's kind of like, when you pay,
That's right.
right?
That's right. Please. Well, in your case, obviously, this is something that I'm comfortable with. Okay, you would determine how many seats do I have in my restaurant, and okay, so I have 30 seats in my restaurant. Okay, now what is it going to take in the kitchen to make that? People in the kitchen? Is it 3 people in the kitchen? Do I need a morning shift to do the prep and an evening shift? You know, so you will lay all that out. Do you have restaurant experience? Okay. Okay. So, and that would help you determine the number of people that you need in each position. Okay. Now, in your particular case, you know, you're going to have a mixture of full-time positions and probably a mixture of part-time positions at different wage scales. Okay. And so for this, the best thing to do is just do a weighted average. Okay. So if you know you got to pay a chef $25 an hour and you're going to pay a line cook $20 an hour, just put in $22.50. Does that make sense? Okay. Right. You don't own the van. Yeah.
I had that.
Yeah. Yeah. Right. Right. Yeah. And it's best not to have your brand on that vehicle. Make it vanilla, white, black, whatever. Okay. I'm serious. Okay. Forecasting sales. This is the toughest one out of all these. Okay. And I'm going to be honest with you, and I kind of wish we hadn't gone on YouTube with this. You know, you're going to look this is crystal balling. Okay. This is absolutely crystal balling. If you don't have any history to draw on. Okay. And so the first thing you need to figure out is, what are you selling? Okay. And the second thing you need to figure out is, I'm sorry. Are you selling products, services, or a combination of both? That's the first thing. Okay. So for example, the online travel agency is a service. She's not selling a product, but you're selling a product. And the soup business, you're selling a product. Okay. So you need to figure out what you're selling, and then you need to determine what your unit of sale is. Okay. So in your case, it's a travel package in one form or another. Okay. In your case, it could be an entree. It could be a side. It could be a beverage. You need to think about all of that. Okay. In your case, is it a pint of soup or a quart of soup, or, however you're doing it. Okay. So that's your unit of sale. And then what is your direct cost? Well, your direct cost is your cost of goods sold. What is it costing you in material to put this together? We're going to keep labor in a separate area because we just saw that worksheet. Okay. So materials. What is it going to cost you to actually sell this one unit? Okay. In the healthcare, it could be, gasoline, and for the vehicle, whatever your other costs are. Okay. So keep that in mind. And one of the most critical things in this whole process is exactly that, determining your direct cost per sale. Okay. And then determining your price. You should not start out with a price and work backwards. Okay. Don't start out with a price and say, I'm going to sell this widget, okay, for $5.95, and then find out the widget costs you $6. Doesn't make any sense. Okay. I can tell you from experience that menu costing in a restaurant is very complex. You're going to have the same issue. Okay. Because at what level do you get down to the minutia? Okay. If you're doing, a 30-gallon batch of soup, okay, and you have to put 1 cup of salt in the soup. I mean, how do you break that 1 cup of salt down into 30 gallons and then break it down into, X number of pints, right? It just, exactly. And you'll cost that out, but at some point the minutia will just drive you absolutely bonkers. Okay. If you're selling a product, remember, don't buy the raw material at Walmart or Target. Okay. Get it wholesale. 2 reasons. Number one, it's going to be less expensive. Number 2, if you are a reseller, there's no tax. Cuyahoga County, that saves you 8%. But you need a business permit to go to the wholesaler and say, hey, I'm a reseller. You don't tax me. Okay. Setting your initial prices. Consider your cost of goods sold. That's the cost of the material that we talked about in the previous one. Direct costs of producing the products. Add that to the total to create a profit margin. So, for example, one of the things that was very common for us to do in the hospitality industry is we would say we need our menu should not be more than 30% on average of our sales price. So we would cost out our menus, each menu item, right? And we would say that is 30% of X, and that's what we would sell. A little side note, just in case none of you know, with banquets, we would say 25. Because they're a lot more profitable than restaurants. Okay. But they're much more up and down. Okay. So determine what you need. It's not what you personally need. It's remember from that you're going to be paying your operating costs, right? Site and all that other good stuff, right? Your advertising. Okay. So you need money after cost of goods sold. So the other thing to look at is your competition. Okay, what is your competition priced out at? Now, if you're going to be more expensive, you have to get more customers. The other guy, okay? Are you selling a premium service? A free service, you know, oil changes, rotation. When you buy a car, you know, you can go to a dozen Ford dealers. But if one Ford dealer is charging you $30,000 for a car, God help us, and another dealer is charging you $30,000 for the exact same car, but you get 1 year free oil change and once a year tire rotation. Well, that's going to save you about $300. Okay, which one makes more sense? Oh yeah, absolutely. And if you're aware of a similar operation in Pittsburgh or Columbus, or I would go to them, right? Because they're not direct competitors. I had a client who opened a wine bar recently here, okay? And she went to wine bars in Cincinnati and in Tampa and a couple other places and sat down with the owners and just picked their brains. They were more than happy to discuss the pros and cons of what they were doing because she wasn't going to be a direct competitor. Yeah. Yeah. Yeah.
Is there a problem with this too for health? Patients are sick.
Yeah. Healthcare. Yeah, healthcare is a much tougher situation for a lot of reasons. Okay. Yeah. Right. Right.
Right. It costs 100.
Yeah. 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 Right. Yeah. Again, and that's a premium service. And that's what that's an example of a premium service that I was talking. Folks, I want to move ahead here. I really don't want to cut anybody off, but we need to move ahead. Okay. When you subtract your direct costs of your product from your revenue, that is your gross profit margin. And that's remember I said food costs 30% of sales. Okay, that would then give us 70% gross profit margin. Okay, and that's really important because that tells you what you can pay for everything else and still make a profit. Okay, so in the hotel business, for example, I can tell you that to rent a guest room should not cost more than 25% of the total price. Okay, little trick so that when you travel and and you're staying at a Hampton Inn, and the price is $100, it's costing them somewhere between $20 and $25 to actually rent that room. And then they've got, the other expenses on top of that. But that's an example of what it is. And why is it important? It requires you to know what you're selling, and helps you determine the adequacy of your gross price, because then you're going to deduct all the rest of your expenses out from underneath. Okay. Projected sales. What you're going to do is you're going to put in the type of product that you're selling. And you notice here it says recycled products. For the first year, by the way, the worksheet will ask you to do it month by month, but I only showed you the year-end total. You're going to sell 125 of these. The total sales is 250,000. Cost of goods sold 137. Your gross margin is up $112,500. Okay, that means that all the rest of your expenses come out of that 112,500. Okay. Okay. Additional inputs. I'm not going to spend a lot of time on this. Remember, I talked to you about don't be somebody else's credit card and pay your credit on time. That's what this percent in. They're going to pay you in 30 days. You're going to pay your bills in 30 days. Don't do anything else. Okay. If you go to the bank and say, smell a rat, they're going to say, wait a minute, why? If you're charging everybody, immediately, why are you charging? So be careful of that. Okay. Operating expenses, fixed operating expenses. These are undistributed costs. Your utilities. Okay. The interest on your loan, payments on your loan, all kinds of things. And I'm going to show you more of that in a moment. Okay. You know what I'm going to do, Bob? I'm going to just jump right to the spreadsheet. Yeah. So we're going to look at cash flow statement, income statement, sometimes called a P&L or profit and loss statement, and your balance sheet. And that's where I want to focus the rest of the evening. Okay. So I have to stop sharing, right? Yeah. Stop sharing. Okay. And yeah, there. Okay, and then so I've got the worksheet up. Ooh, it's not there. Okay, so, and I'm flying blind here. Yeah. At the there we are. Okay. Here. Yeah. Yeah, there it is. Slide. Yeah. Just okay. And now I need to share again. Is it this one? In the upper corner there? That's not it. No. It's been about 3 years. See, but so he has to be nice to me. Okay. Okay, good.
You owe me.
Yeah. Okay. There we go. The first thing we're going to do is look at the cash flow statement. Okay. Why is cash flow important? It's going to tell you if you're generating enough cash to pay your bills. Okay. So, what I'm gonna do here, Bob, is I'm actually gonna make this just slightly smaller. Yeah. There we go. Okay, can everybody see that? Okay. Okay, does it need to be a little bit larger? There, okay, that's better. Okay, so the cash flow statement, by the way, you don't have to fill this in. If you fill in the other worksheets that I told you, the workbook actually creates this. You don't have to. Okay. So, the beginning cash balance will come right out of that. The working capital, that's your worksheet that I showed you a few moments ago. Okay. Don't do accounts receivable. Okay. You don't want to get that. Then here are your cash outs. And you won't have any activities like, since normally you don't do that in the first year, you buy what you need. Up for something farther down the road. That's what. Again, okay. Activities. It'll show this for you automatically. Direct operating taxes, and then your financing activities. It calculates your loan payment for you automatically. If you're going to normally in the first year deal with that, okay. If you negotiate revolving credit, in other words, a line of business credit in addition to a loan, you have an additional $5,000 or $10,000 that you pay for on an as-needed basis with a lender. Dividends, master relationship. Not, that's going to give you your total cash outflows. Okay. And net cash. Now, notice, I want to show you this here. You notice that the net cash outflow for Ann's nursery in the first 3 months is negative. That means Anna's spending more money than Anna's taking in. Okay. But then what happens? Well, things got a little bit better because it's a seasonal business. Okay. And what I want to show you here, if I can do this, is at the end of the year, you notice that the net cash flow for Ann is $6,700 negative. What that really means for her, and I'm just going to point to it right here, hopefully everybody can see that, is from a cash point of view, she basically broke even. Okay. If you can do a forecast a year out, okay, and come that close to breaking even, banks are going to say you broke even for the year. Okay. They're going to be happy with that. I swear to you, they're going to be happy with that. Okay. If you show a positive cash flow, that's even better. But if I was Ann, I would not sweat with that $6,700 negative. Why? Because that means I could easily do better than that. Okay. So wanted you to see that. And then any line of credit drawdown, did she need additional money from the line of credit to stay operating? Okay. And in fact, you'll notice here in the first couple of months, yeah, she had to do some additional lending, right? 13,000 the first month, 11,000 second month, but it got better. Only 2,900 in the third month. And then her ending cash balance, again, that it'll show that to you automatically. And then your line of credit balance. You notice it goes up because she hasn't done any payments on it. Okay. If she had done some payments, it would start to come down, and you know, it does that calculation for you automatically. You determine when you want to pay down on the line of payments. Okay. So the importance here is, do you have enough cash to run your business? That's what a cash flow statement is. Revenue in, expenses out. It's just that simple. Okay. The next one that I want to show you is, I just need to get over here. Your income statement, sometimes called a P&L, profit and loss. Okay. Now, in this particular case, it actually breaks down by product. In this case, Anne was selling small ornamentals, large ornamentals, local sales. That was one of her channels. Web sales were another one, and distant. She was selling to the other side of the country. Okay. Sales. Okay. So the top part of it records her sales by product. The next section down shows her expenses, cost of goods sold. What did it cost her to sell that? You know, what was her costing her to actually grow the products? Her gross margin, we've already talked about that. That's the sales less her direct expenses. Here are her operating expenses: payroll, advertising, her vehicle. Commissions are only used if you're paying somebody on a commission basis. You're basically an independent contractor, but they don't do something unless they do something for you. They don't get paid unless they do something for you. That's a commission. Normally, you may pay salespeople strictly commission. Okay, they go out and generate business for you. They get a piece of it. Okay, legal and professional, insurance, other than health, licenses. You know, we've gone over a lot of this already. And then you have your total operating expenses, your income before other expenses. Now notice something here. Income before other expenses. In month 3, Anne basically shows $880 of profit. But you notice she had a negative cash flow. Okay? 2 different things. And the reason why, okay, is because by month 3, she was actually generating enough money to pay for her expenses. That's the $880. Okay. Although she was not having enough money to sustain the business at that point. That's the difference. Okay. And then here's where it gets really interesting. This income before other expenses. Some of you, has anybody here ever heard the term EBITDA? EBITDA? Do you know what it stands for? Earnings before interest, taxes, depreciation, and amortization. Okay. If any of you have, investments in the stock market or whatever, you want to look at EBITDA to see how your stock is doing. Okay, because stock valuations are normally based on EBITDA. Anyway, the reason for that is because income before other expenses, or EBITDA, is really the profitability of the business. Okay, called amortization and depreciation. Remember, I told you in the first worksheet that you have the fixed assets and then you have the working capital. Remember that? Okay. Well, you're allowed to recover some of your costs on that investment in both working fixed assets and in working capital. Depreciation applies to fixed assets, and it's normally a 5, 10, in the case of buildings, it's 25 or 30 years that you can actually take the cost of that and reduce it. For tax purposes only. For tax purposes only. It's a tax break for you. Amortization, the same thing, except it's your startup costs. Okay. If it costs you $10,000 to build a website, that's a startup cost for you. And over a legal period of time, normally 2 or 3 years, you can amortize that cost. You can amortize your initial inventory over 2 or 3 years. Okay. And reduce the amount of money you owe the government. That's depreciation. Okay, that's a fixed asset because it's attached to the building. So that makes it a fixed asset. Okay, so that's good. She has a schedule there again. The computer will for you, and then her loan payments, all the different sources, any other miscellaneous expenses, the in, and you notice that income, then it will calculate the income tax for you automatically, and then show a net profit. That net profit, the big difference between this and the working capital that we talked about in the cash flow statement a moment ago, is that net profit is with all the tax benefits filled in. Okay, so you notice at the end of the year, she's showing a $6,400 net profit, although at the end of the year, she had a negative cash flow. So does everybody understand how depreciation and amortization really help you? Okay, that's important to understand. Okay, because again, if you were a lender, you look at this and say, Anna's breaking even the first year. And they'll be okay with that. So the last thing I want to show you here is balance sheet. The balance sheet basically describes the health of your business as a snapshot in time. Normally, balance sheets aren't done until the end of the year. You might look at them quarterly, but basically at the end of the year. And it's not surprising. You may have, if you have a lender, the lender may want to look at your balance sheet at the end of the year. Okay. It shows all your assets. Okay. And assets are broken down into fixed or current assets, and then fixed assets. Fixed assets are going to be your building and your leasehold improvements and all that. Your current assets are liquid assets, cash, accounts receivable, any prepaid expenses, anything that is, if you close the business today, you actually have cash. And then your fixed assets, and then notice their accumulated depreciation. Okay, how much money have you put into depreciation, which actually reduces your assets? So you could, for example, have a vehicle on the books for $30,000, but if you've had it for 5 years, it may only be worth $10,000. So the accumulated depreciation would show there as $20,000. Okay, and then you have all your liabilities. Okay, current liabilities, accounts payable. Okay, and all your loans and all that. And then you have long-term liabilities as well. And so what you do is you subtract your liabilities from your assets, and that gives you your equity. Okay, and that's what is your stock in your company really worth. And that really determines the worth of your company as far as your lender is concerned. So in this case, Ann's equity in year 1 is 121,000. And you notice by year 3, it's gone up to 226,000. Okay, so she grew her equity, and you'll see a line there that says retained earnings. And what that is that's the difference between your assets and your liabilities. Because you notice her equity is 115,000. That's what she put into the business. So anything additional becomes retained earnings. Not necessarily, but the answer is, in general, for small businesses, the answer is yes. Okay. Get into larger companies, S corps and C corps. Okay, it's often a multiple of your retained earnings. Okay, multiples, and it depends on the industry. So, for example, the energy industry is about 10 times that. For hospitality industry, it's normally about 5 or 6. Okay, because what that is doing is saying, based on this, what can future earnings? Okay, they do it based on that. But for small businesses, that's the value of your business. Okay, we're going toward the end here. I just want to give you a taste of this. Again, if you fill in the worksheet with the first couple tabs that we talked about, tabs 1 through 5, all the rest of this is automatic. It's automatic. Okay, so I'm going to bail out of this now. And I want to stop sharing again. Okay, and I want to go back to the PowerPoint quickly. Point is, there we go. And we need to share. There we go.
Let's see.
So what's that?
Yeah, it'll come back.
Okay. Okay, thanks, Bob. Okay, so here's your break-even analysis. Again, the workbook actually does this for you automatically. And the formula that you need to understand is your fixed cost, which is that fixed operating cost, right? That you saw in the income statement, divided by your gross margin percentage. Remember, I told you that 30% food costs, the 70% is your gross margin percentage. So our break-even analysis would be, let's say $10,000, which is my food fixed cost per month, divided by 70%. Okay, or 0.70. Okay, and I'll tell you what your break-even analysis is. Okay? There are a whole slew that this generates for you. Okay, and your accountant can explain those to you, or even better, your score mentor can explain those things to you. Okay, and the last thing I want to talk about real quickly is record keeping. Record keeping is essential. don't do shoe box record keeping. Okay. Use QuickBooks, use FreshBooks, use Xero, there are dozens of programs out there, or you can create your own spreadsheets if you're comfortable with Excel. Okay. And sales, expenses, draw a line at the bottom and just add them up. Okay, very important. Yeah. Okay. Any questions before we close? You folks have been really patient. Okay. Thank you. Thank you. I timed this out at 1.5 hours. I'm not sure where it went wrong, and I apologize. So okay. Don't forget, next week, you'll be meeting with one of the best people in Cleveland on how to find money. Okay, we strongly recommend that you attend 7 o'clock next Thursday, right here. Okay. Everybody have a great holiday weekend. Be safe.